Welcome and thanks for watching this brief investment video. I'm Ross Bramwell, a member of Hamrickberg's investment team. The Federal Reserve, or the Fed as I'll call it, once again kept its key interest rate unchanged at its meeting last week. In this video, we're going to discuss how the direction of interest rates or yields has impacted stock market returns over the short term. Although corporate earnings have continued to beat expectations and we believe are the long-term driver of stock market returns, it is hard to deny the focus that investors have had on the direction of yields and how that has impacted stock market returns over the last year. To begin our discussion, let's look at a chart of the S&P 500 over the last year. Here shown as the gray line, S&P 500 total return on the left axis, along with the 10-year U.S. Treasury yield, the red line shown on the right axis. The last two stock market pullbacks occurred during a rapid increase in yields. First, we had the 3-month stock correction that started in August and went through October of last year, and this occurred as the 10-year Treasury yield pushed towards 5% at its peak. This was when the market was grappling with higher than expected inflation data and concerns about the deficit as we entered a period of multiple government debt ceiling deadlines last fall. The second stock market correction occurred this spring, and although it was shorter, it occurred during a quick rise in interest rates due to hotter than expected inflation data and a realization that higher for longer rates would be the economic backdrop for longer than initially expected. We have discussed in prior videos how almost all of the stock market return over the last year has been due to multiple expansion, not due to higher earnings. A quick change in interest rates can immediately impact valuation calculations, especially in growth stocks that tend to have higher valuations and in today's environment are often at even more elevated levels. This has led to some of the short-term volatility we have seen while rates have risen. It's been an adjustment in valuations, not necessarily a slowdown in economic data. Here we have the same chart, just highlighting the opposite relationship. When interest rates or yields have declined, it has generally led to stock market hitting new highs this year. It was that case in early November last year when the Fed indicated that the rate hiking cycle was finished and that the Fed's next move was likely a cut. Yields declined on those comments, and this immediately put in a bottom for stocks, and the stock market has been in rally mode ever since. We can see the same relationship in April of this year after the short 2-week pullback we mentioned earlier, that stocks moved to new highs as yields declined after better inflation data that we received this spring. There was one period where interest rates and the stock market went up at the same time. That was during the first few months of 2024. Yields moved higher due to better than expected economic data that significantly lowered the risk of recession that everyone was expecting in 2023. But because the Fed had signaled its next move, investors were looking past the current data and focused on the fact that rates would move lower at some point. The market had moved ahead of the Fed in its thinking and expectations and had initially priced in 6 rate cuts in 2024. This led to the market rally in early 2024. As we sit here in June, the market has had to adjust its expectations due to stickier inflation and now just projecting 1 to 2 rate cuts by year end. But the market still believes cuts are on the horizon. After 3 reports to start the year that worried investors about inflationary pressures, the last 2 monthly prints on inflation data have put us back on the track of inflation is likely trending downward. We still believe earnings growth will drive the markets over the longer term. Estimates are for around 11% earnings growth in 2024 and 14% in 2025. These estimates have supported the market at record levels. As we have seen over the last year, as long as economic data remains positive, the market may be susceptible to pullbacks during periods of rising rates, and the stock market may likely move higher when rates are declining. If economic data, including the all-important jobs market, began to decline or soften due to economic conditions deteriorating, this relationship would likely change. Thanks again for watching this brief investment video. If you have any further questions, please reach out to a member of your client service team. Thanks again.